Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, April 18th, and then we'll see how things look for Wednesday, April 19th. We had a slight up day on Tuesday. The market's looking a little bit tired, kind of sleepy, a little bit exhausted. Wasn't a lot of conviction. We saw some action right after the open, but then everything settled down and danced above and below the unchanged level. We haven't really been able to work off this short and even intermediate term overbought condition, but we haven't switched over negative either. So we're still looking positive overall. We have some overhead resistance above current price. If we start to fall, we do have some support. Before I get started, please be reminded from April 22nd through May 14th, I will be traveling. My hope is to do the daily videos. I do have a podcast, and please also note that there's a PDF in the description for the podcast as well as the videos. I do have a private Facebook group that you can join. I do have a poll that is posted. Please feel free to check that out. Also, for Tuesday's video, I had a really difficult time uploading the video to Rumble. It finally uploaded about an hour before I'm recording the video for the next day. I don't know what the problem was. We ran into this problem a few weeks ago. If you are watching this on Rumble and you're just not getting access to the video, if you desire to, please feel free to check out YouTube. That's one reason why I upload in multiple locations, because we never know what might happen. Let's go back and talk about what happened. Right at the open, we had a gap higher open, and that set the high for the day. Prices were able to rise above R1 at 41.61. We almost got up to R2 at 41.71, and that's upper resistance that we've been watching. Prices then fell back down to the unchanged level and found support at the daily pivot at 41.42. As the day went on, prices rebounded and drifted both above and below the unchanged level, and we closed slightly positive. We were up 0.09% on a continuation of below average volume. The technicals, as I said, are still mainly positive overall. We're still a bit overextended to the upside. We're getting a little tired here right now. The markets continue to be fixated on inflation and interest rates. We also have earnings that are coming out. That's more on a business-by-business basis, but it could also influence either a sector or the entire index, depending on who's releasing and how the reaction goes. We do have some more Fed speak to go through today, and as always, lately, we're still wondering, is there going to be any more banking information that comes out? Here's the intraday chart showing how we gapped higher above R1, almost made it up to R2 before falling back down to the daily pivot. We danced along that level for a while. Then we shifted a little bit higher, went above and below the unchanged level, and then going into the close, we were just slightly positive. Large cap growth and value also chopping sideways, showing how overall value is still outperforming growth, but for the large caps, growth did a little bit better than value. For the mid caps, it also did a little better, and for small caps, they were pretty much even on the day. Here's the intraday chart. We were going sideways in the overnight session. Then we started to go positive with the futures. We took that over into the open of the stock market. That was the high that we set. Everything fell back after that, below unchanged, dancing above and below the unchanged level. And currently we're drifting a little bit lower and slightly negative in the after-hour session. What are some comments that we can make? St. Louis Fed President Bullard came out, who's no longer a voter, and said that he supports raising interest rates further since inflation remains persistently high. Markets didn't really care for that. Then Atlanta Fed President Bostic came out, who's also not a voter, and said that he thinks that the Fed should hike rates one more time and hold rates there for quite some time. This statement is pretty much what the Fed has been saying consistently. Volume continues to be below average. On a short-term basis, we have the moving average steady, stochastic, CCI 14, Stoch RSI, and Williams %R that are extreme positive, and this list hasn't changed. The next list hasn't changed either, with the TTM squeeze, the PMO study, and the Sean trend meter. The dollar was down, but we're still above that 100 level, and interest rates were mixed. The home builders ETF negative divergence, it's still there. It is improving, but as we continue to go beyond this, it becomes less relevant, but we're still watching that chart anyway to see if it can give us some insight. The 30 to the 5 is back to being normal, where the rest of our yield curves remain inverted. Sentiment is positive at 68. It ticked down a little bit from 69. Our trend is still positive, but weakening. The green line actually turned back up just a little bit, but it's not showing an awful lot of conviction. However, when you look at the ADX, we are above the moving average, but we're still below 20. Our bias is now positive. We had 2 positive days in a row, even though it was not a big move whatsoever, and I've kept our momentum at mixed. Economic reports that came out. We had total housing starts, which were down 0.8% to a seasonally adjusted annual rate of 1.42 million, which was greater than the 1.407 million they had expected. Single unit starts were up 2.7% month over month to 861,000. Building permits were down, and this can be a leading indicator, so that's a bit of a concern. Looking at some Isabel net charts, here's the overbought, oversold condition. Based on this chart, we're getting a reading of 76.94. When we get above 80, that's when we start to get extreme positive. This looks at the net margins of companies, and the yellow area is what they're forecasting going forward here, where they do see it going down, but then also going back up. And this has been part of the problem lately, where they're lowering the earnings per share on a real basis. But when looking out into the future, analysts are still having pretty optimistic conclusions right now. This chart deals with gold. It says investors say gold is overvalued for the first time in 19 months. It's really starting to spike up and getting a lot of attention. This is looking at cash and cash equivalent allocation against the long-term average, where cash has really been going up. It's up 14% according to this chart. Then they ask folks at JP Morgan, are you more or less likely to increase or decrease your equity exposure? It's actually dropping right now as the market hits some rough times, where only 26% say that they will increase their exposure. This is what I'm talking about with the earnings per share. The consensus earnings per share, according to this chart, is falling off a cliff. It's down 13% from June of 2022. The blue line is what is actually happening. The yellow line takes out COVID and the global financial crisis, and we're even going below that, where the blue line here is the historical average, and we're even dropping below that. Looking at growth projections worldwide, the global economy was up 3.4% in 2022. They expect it to be up 2.8% in 2023 and 3% in 2024. The advanced economies are actually underperforming the emerging markets and developing economies. This chart just shows how the money market fund assets are really continuing to decrease, and I'll address that again in just a moment. When you're looking at equity futures positioning in the S&P, the blue line is the asset managers, and they're still not necessarily long in the market. Equity positioning still is below zero, which means people are more risk off and not willing to get into more riskier assets, meaning stocks. Then looking at real investment advice, at the top it says every transaction in the market requires both a buyer and a seller, with the only differentiating factor being what will the price be paid, either to buy or sell. Since this is required for market equilibrium, there can be no sidelines. I've alluded to this from time to time, saying that, wow, look at all this money going into money markets. Eventually that'll go into the stock market and really produce some support. And that can happen to a degree. But what they're putting forth here is that it doesn't really work out that way. The real reason why money is going into money markets is because it's getting a higher yield. And so people are taking it out of their savings account, putting it into a money market account, getting a better rate of return that they don't necessarily intend on putting into the stock market. This chart looks at two different factors, the disincentive of taking risk versus risk-free returns. And that's what you're doing. When you're in a savings account, when you're in a money market, that's considered to be risk-free. And why put your money at risk if you're happy with the return that you're getting instead of putting it in the market where there is a lot more risk? This chart measures the difference between the savings, the risk-free rate, and the equity risk premium. The risk-free rate is really going up, so they're asking the question, why take the risk if you're happy with the return that you're getting? We're also keeping an eye on the dollar, where it sits at key support, right at about the 100 level, and we're still above that currently. Then looking at the equity to money market asset ratio, these are folks that are in the stock market, and they're heavily invested in equities. They don't have a lot of cash. This line would be a lot lower, meaning if there was money on the sidelines waiting to go in, this line would drop. Now, on the other hand, we're getting to the extreme negative where the retail money ratio is showing that retail investors just don't have any money to put into the market. And the same is true with the mutual fund cash level. Typically, when you're in mutual funds, you'll first put your money into a money market before you deploy it into a mutual fund. And these levels are really quite low, meaning that the funds that have been deposited are already in the market. So there's not this sideline mechanism waiting just to launch things higher. This looks at money market funds, their total assets, and how it has been going up. It really went up during the pandemic, and it continues to go a little bit higher during this banking crisis, and then compares it to the Fed funds rate. So if there's a lot of additional money in money markets, and it's not by individual investors who are putting money into the market, where are the funds that go into money markets? And this is kind of a confusing chart, but basically it's with the big institutions where they have millions, sometimes billions of dollars placed in these money markets that are getting a return that they don't necessarily want to deploy into the market. They just like the idea of getting the return in the money market itself. Another thing that kind of does not bode well for the economy is the CEO confidence survey. The blue line has really been dropping. And then there's the arithmetic average annual return of the S&P 500 over different periods. From 2017 to 2021, which is a gangbuster year, we were up 15.57%. This looks at the government interventions against the stock market going back to 2008. The blue line is when the government got involved to try to save people from things falling apart, and that has remained pretty high. And then we had the lockdowns with the pandemic stimulus, and it's still very high overall. General business conditions continue to show a deterioration. The blue line measures the current conditions, which is actually showing some improvement, and they're expecting things to get a little bit better, but it's still quite low overall. Then this just looks worldwide at the probabilities of going into a recession. The UK is in first place at a 75% chance, followed by New Zealand, and in third place is the US at 65%. Edward Yardeni had a couple of charts showing that the S&P 500 operating earnings per share, it's continuing to drop overall. And then on this chart, he shows the operating earnings per share and how they have all been coming down overall. And then he also included in his email a check-in with Joe Feshbach. He says, "We checked in with Joe this past weekend to get the latest thoughts on the stock market." And he writes, the S&P 500 is approaching its early February high. That's the overhead resistance that we've been talking about. While it may exceed that, I believe the bulk of this rally is behind us now. I suggest building up some defensive reserves for a better opportunity down the road. The sentiment measures just don't support meaningful upside from here. Furthermore, the widely spoken about tech rally looks to me, chart-wise, to be about 90% done. Now, this is an opinion, albeit an educated one. This is useful to know, but I wouldn't necessarily make decisions based on what this is saying. Some other charts that I ran across. This is from Sentiment Trader, which is an excellent website. It shows that the dumb money, and unfortunately that's us, it's starting to increase overall, even though it's not really getting to an extreme level right now. Then we have the margin statistics coming out from FINRA. It says that margin debt was up $21.1 billion month over month from December into January. And this could add some fuel to the fire for sure, but it also puts folks at a lot more risk. Then Lisa Saunders put out this where the S&P 500 earnings yield has really been going down, and it's actually crossing below the 3-month yield. Another thing that we've been keeping an eye on are the small caps, and the small caps are still 30% above their historical trend when you compare their earnings. This chart, also from Sentiment Trader, also shows the corporate insider buy-sell ratio. It shows that there's a lot of insiders are aggressively selling. That could eventually feed over and put some pressure on the tech sector. This chart just shows how all employees, including temporary help, is now finally starting to drop down, and this is when we typically head into a recession. But a Bank of America survey shows that they're overweight in cash, and I'm not sure what alternative investments are, where they tend to be very low overall in equities. This chart just says 35% of investors expect that the Fed will start an easing cycle in the first quarter of 2024. Tom McClellan had an interesting chart that he posted. Here's the investors' intelligence, where it's actually starting to outpace the rise in the S&P 500. And here's another chart showing the S&P has now gone 18 days without a 1% drop. Now, getting into our charts, still showing that fear is quite low. The VIX continues to fall, and if you go on Twitter, this is one of the main topics that people are talking about, is the VIX is going down, 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 and everybody has their opinions. Volatility is picking up a little bit with the VIX of the VIX. We're also getting down to an extreme reading with the RSI 9, meaning that the VIX has fallen pretty far, pretty fast. We had the latest reading of the American Association of Individual Investors. We saw a little bit of a tick up here, but our moving average is still coming up slightly after having an extreme negative reading, which could give some support to the market. Here's the SKU index where it continues to go up. It didn't produce a big down day like that tweet I referred to yesterday. The VIX is continuing to fall, but we're seeing the SKU index starting to go up. Now, the VIX measures things with at-the-money options, where the SKU index looks at out-of-the-money options, either above or below current price. When we really start to pay attention to this is when it goes up into the red area. And even though it's climbing up, it hasn't reached that area yet. This indicator does not suggest that there's a big move on the way, either up or down. The equity put call ratio really hasn't changed very much, but still could be giving some support to stocks. Fear gauge continues to fall down, and this fear gauge is also continuing to decrease. This chart just shows that we're still favoring the risk-off posture. Looking at the condition of our trend, the green line turned up just a little bit, so it's getting a little bit more positive. The red line is declining. The ADX is above the moving average and advancing, but we're still below 20 overall. Even though we're defaulting to a trendless environment, we would default to positive. The Arun indicator is still showing some improvement and starting to get a little extreme positive here, showing that buyers are in control as sellers dissipate. Looking at the daily chart, it looks like we're putting in a series of higher highs. We may not be going up all that much, but intraday, it is looking a lot better, but we're starting to get right up to this overhead resistance that we're dealing with. If we fall, we're looking at support at about the 4100 level. If we fall below that, we're looking at the 50-period moving average, and even below that is the 200-period moving average. On the bottom, we see where volume is still below average. Our 20-period exponential moving average is just barely extreme. We were flat with the 50-period as well as the 200-period moving average. The CCI 14 remains extreme positive. The slope is the only oscillator that we have, which is starting to roll over. The other ones are still clearly positive. The PPO study is still looking positive in the long, intermediate, and short term. The Stochc RSI is extreme positive, as is the Williams percent R. And then our stochastic study showing short, intermediate, and long term still remain extreme positive. The force index is also positive. We're still above all the plotted moving averages. The parabolic SAR is positive. Swollen trading oscillator based on price turned down just a little bit, but we're still seeing a bit of a negative divergence here when we look at volume. However, it's still positive overall. The vortex is positive with the green line going up and the red line going down. Sean trend meter getting extreme positive. Shaken oscillator was pretty much flat, but still positive overall. This is another warning sign I've been pointing out for over a week now, where the S&P is not outperforming the utilities. We want to see this ratio going up, and it's actually going down, and at best, it's going sideways. PMO study, dropping down after being extreme positive with the percent of PMOs that are rising. We're still extreme with the buy signals, and we continue to go up with the PMOs that are above zero. The BPI ticked up just slightly, but you can barely see that on this chart, but this is still positive overall. The NYSE BPI actually is crossing above 50, so that's turning more positive. The Chaikin money flow still is looking positive. The balance of power is also positive. TTM squeeze trailing off a little bit with the darker blue bars here, but still positive. The go, no go continues to be positive with blue bars. We're still above this anchored moving average going back to the all-time high, and these 50-period moving averages continue to advance. This is the same chart. If we fall, we're looking at the 40, 74 to 75 level as potential support. Looking at the fib levels on the short-term chart, we're still above this 41.23 level. That could act as support if we fall. Longer term, we have overhead resistance at 41.56 that we've been unable to break through. We did it on an intraday basis, but we didn't close above that level. Longer term, we have overhead resistance quite a ways away from current price. If we fall, we're looking at 40.20 for support. Our quadrant is also showing overhead resistance that we're having a real difficult time breaking through. The S&P equal weight continues to underperform the S&P 500, and this also is showing that in that same chart, but we're chopping pretty much sideways with this ratio. The Elder Impulse System remains neutral. The McClellan Oscillator, it ticked down a bit, but is still positive. The Broad Range McClellan Oscillator also declined, but is positive. The Summation Index based on price and volume continued to be positive. We're still looking at this divergence here where the S&P was able to break above this blue line. So far, the NASDAQ has not been able to do that. The transports continue to underperform the Dow. The new highs actually broke out a little bit, but it's not really helping our 5-period moving average at least yet. 10-period, we're going pretty much flat with a slight increase. The advanced decline line, we're still seeing a breakout based on price and a negative divergence when you compare it to volume. The NYSE advanced decline line still is looking pretty strong. And then looking at common stock, we have a longer term negative divergence here where we made a higher low based on price, but a lower low based on volume. The advanced decline ratio is still positive. Accumulation distribution also positive. Volume continues to drop. The money flow index is still positive. The ultimate oscillator ticked down just slightly, but it's still positive overall. On balance, volume continues to be positive. And this is one I haven't shown other than in the deep dive video. We're just getting ready to cross here with our special K. This is a very long-term oscillator. The last time it crossed over negative was right when we hit trouble in the early part of 2022. If this is going to cross back over positive, could that signal some positive things looking forward? The financials continue to bounce up a little bit, but are still in an overall downtrend. And the regional sector compared to the financial sector continues to show weakness. The broad range of our advanced decline studies, the NYSE, still above the moving average, as is the S&P and mid caps. We're still below the moving average with the small caps. The Dow still having a hard time breaking through this R1 pivot level. The diamonds continue to be neutral. The NASDAQ also just chopping more or less sideways, not able to break above this double top at least yet. The NASDAQ 100 did break out above this double top, but has also been chopping sideways. The Qs remain neutral. The NASDAQ 100 is still above this 38.2% retracement level at 12,864. If we fall, we'll be watching that for support. We're also breaking out slightly above this anchored moving average going back to the all-time high with the Qs, which measure the NASDAQ 100. The micro caps were down slightly but did not set a new 52-week low. The small caps remained under pressure. They have not been able to regain the 200-day moving average and are below this pivot level. The Russell 2000 index still positive with the MACD. We're still above 50 with the RSI, but we're still below the 200-day moving average, acting as resistance. The small caps have changed back to neutral for the Elder's Impulse system, and the small cap ratio continues to show weakness compared to the S&P. The mid caps still continue to dance along the pivot point, and the mid caps have switched to neutral. Here's the home builders where we were going up with the S&P. We're going up with the home builders. The ratio is showing some improvement, and the relationship is getting stronger, but we want to see this ratio really start to break out, and it's just not doing that yet. The Copic curve still has a buy signal, but starting to roll over, and the next day or two, that may go away. The Pring Bottom Fisher also rolling over, and this signal may go away very soon. Bond yields were little changed to slightly down, where bond prices were little changed to slightly up. Here's a look at the MOVE Index and the VIX. Volatility picked up just slightly with bonds where it's decreasing with stocks. The correlation between the two still remains very strong. Here's another new chart that I've never shown before. This is a weekly chart of the S&P on the top, and this is taking the 1-month yield and then subtracting the 3-month yield, and look at how it's really dropping off right now. Other times when it fell, look at the numbers at the bottom of what years these happened. Our long-term trend, we're still holding up with the MACD above 0. It's still looking like this break above the trend line was legitimate. An update of our possible positive scenarios, we're still extreme positive with the 10-day average of the S&P highs minus the lows. We're still working off a SWAG NYSE breadth thrust. That can go on indefinitely. And here's a look at the statistical returns that you might be able to get looking anywhere from 1 month out to 12 months out. We're still below zero with our 5-period moving average taking a broad measure of the market overall. That is more negative. Looking at the growth to value ratios, we're dropping down a little bit with the Qs to the S&P. A little bit of improvement with discretionary to the S&P, dropping slightly below the moving average with large cap growth compared to large cap value. Here's the growth value ratios with the large cap falling off, mid cap showing some improvement, small cap still down at the moving average. The 50-period exponential moving average of new highs, new lows still is positive. The indicator remains above zero. The longer it can stay above that, the better it will be for the market. The 2-year Treasury came back up slightly. We're still wondering if this spike will give some support to stocks. The Staples ratio, we're still wondering if this spike is viable, but we won't really know that until we look back on this, so we have to kind of guess right now. So far, it's looking okay, but we're not really falling in this ratio overall. What's our outlook for Wednesday? Earnings season is now upon us. The technicals are positive, but continue to be overbought. We have the weekly MBA mortgage index coming out, as well as the Fed beige book. That's about an hour or so before the close. Not a big influential thing, but because the Fed is so in your face right now, they might get some information out of this report. And all the different geopolitical events with inflation and interest rates being the main concern for the market right now. We did have a speech that was given on Tuesday. We have a couple of speeches coming out on Thursday and then another speech on Friday. Looking at the Stock Traders Almanac statistics, we tend to be positive for the month of April overall. Then looking at April 19th, where the Dow is neutral to positive, being up 61.9% of the time. The S&P and NASDAQ are more positive, being up 71.4% of the time. And then April tends to be a positive month. And then I'll try to give enough time if you want to pause this. These are the things that are working in the background right now to give us a yearly positive seasonality based on what has already happened. We're on the 12th trading day of the month, where we see the green line actually a little bit lower here when you're looking at a pre-election year. Our scenarios, can't really go with the down one because things are pointed up, but we remain overbought. Can't really go with the up one because we're not trending very much right now, and the market still looks kind of tired. So we're defaulting more to the sideways trend. The ADX is above its moving average, but it's below 20. We are positive, and the green line's turning up a little bit, and I haven't decided to change that back over to advancing yet. I want to see a couple of back-to-back moves before I do that. The warning signs, volume is still below average. The S&P is still overbought. The VIX is still showing complacency. The S&P is still underperforming utilities. The new highs, new lows are lagging, but showing some improvement. We still have a risk-off posture. The small caps continue to underperform. The NASDAQ may be declining from a double top. The home builders are showing a negative divergence, but the longer we go out, the less relevant that becomes. And earnings season is underway, which could be positive or negative. So our conclusion, the S&P is positive, but continues to be overbought, short and intermediate term. Long term, we are still positive because we had a recent golden cross and we remain above the 200-day simple moving average. Thank you. I hope you found this video helpful. I'll try to do what I can to post to Rumble. Hopefully it'll be in a timely manner. So we'll just hope for the best in that whole situation. I hope you have a great day, and I will talk to you in the next video.